Imagine you have $10,000 to invest today. Two people invest exactly the same amount. But one decision can lead to a very different result. Welcome to MU Wealth. Here, we make investing, money, and wealth building simple. No confusing jargon. Just practical financial education with real examples. Today, we are looking at one investing mistake many Australians make. They only invest in Australia. Before we continue, this is not an Australia versus America video. Australia has fantastic companies, and Australian shares can absolutely be part of a strong portfolio. But the question is not whether Australia is good. The real question is, should Australia be your entire portfolio? The Australian share market is much smaller than many beginners realize. ASX says over 2,000 listed entities call ASX home. That may sound like a lot, but compared to global markets, it is still only one part of the investing world. Now compare that with the United States. The S&P 500 alone includes 500 leading US companies, and those companies cover around 80% of the available US share market by value. When you invest in the S&P 500, you are not buying one company. You are buying exposure to hundreds of major businesses. Now let us use a real-world example. This is our MU Wealth reality check. Imagine two people each invest $10,000 at the start of 2025. Person A invests in an Australian share market ETF tracking the ASX 200. Person B invests in an S&P 500 ETF. In 2025, the ASX 200 total return, including dividends, was approximately 10.32%. So $10,000 would have grown to around $11,032. Now compare that with the United States. In 2025, the S&P 500 total return was approximately 17.9%. So the same $10,000 would have grown to around $11,790. Both investors started with exactly the same amount of money. After just 1 year, the difference was about $758. But 1 year's performance should never be the only reason you choose an investment. Markets go through different cycles. Some years Australia performs better. Some years the United States performs better. The goal is not to chase last year's winner. The real lesson is diversification. Do not depend on only one country, one sector, or one market. There is a name for investing too much in your own country simply because it feels familiar. It is called home bias. Home bias is common because we like what we know. Australians know CBA. They know BHP. They know Woolworths. So they feel comfortable buying Australian shares. But familiar does not automatically mean safer. If most of your portfolio is in one country, your money is exposed to that country's economy, interest rates, and industries. Australia is strong in banks, mining, resources, and financial companies. These are important sectors. But they are not the whole world. The US market gives exposure to different areas: technology, artificial intelligence, cloud computing, semiconductors, healthcare innovation, and cybersecurity. This is one reason many investors do not choose between Australia and America. They own both. And if you are also interested in trading, the US market offers even more opportunities. There are more stocks, more ETFs, higher trading volume in major names, and usually tighter spreads in highly liquid companies. The US market also has a much larger options market. Many large stocks and ETFs have weekly options. Some even have daily expiries. But options are not for everyone. They involve higher risk and should only be used if you understand them properly. So should a beginner start picking US stocks immediately? Not necessarily. For many beginners, ETFs are a simple way to get diversified exposure without picking individual stocks. An Australian ETF can give you exposure to Australian shares. A global ETF can give you exposure to international shares. The key is learning how they fit together. Here is my MU Wealth take. Investing in Australia is not the mistake. Investing only in Australia can be the mistake. I do not believe Australia is enough by itself. And I do not believe America should be your entire portfolio either. The goal is not to predict which market wins next year. The goal is to build a portfolio that can survive and grow through different market conditions. Let us summarize. Australia has great companies. The US has great companies. One good year does not make one market permanently better. The real lesson is this: do not limit your future to one country. Great businesses exist all over the world. This video is for education only. It is not personal financial advice. Always do your own research and consider speaking with a licensed financial advisor before investing. Thank you for watching MU Wealth. Until next time, the market doesn't need to change. Our decisions do.